Hello everyone. Today we are going to continue our journey in the small open economy model without money. In this lecture, we are going to generalize the baseline model introduced in the previous lecture and then apply this model to explain the business cycles in the globalized economy. And again, this is to show you where we are standing at in the macroeconomic theory. There are three learning objectives today. The first is to extend our small open economy introduced in the previous lecture to have production and investment and derive the current account in this complete small open economy model. The second job is to know how to analyze the effects of a change in exogenous variables like interest rate, government expenditure, current productivity, and future productivity. And the last is to understand that these effects on the small open economy can be different from those on the closed economy. In the previous lecture, we have introduced a simple small open economy with credits, where consumers and governments are trying to dynamically optimize via the credit markets to determine their optimal national savings or current account. But in that model, we do not have any production process. In this lecture, we are going to extend the simple model to include the firm's behavior so that there will be investment as well as the production. In this case, the aggregate demand is now equal to its complete version, the C plus I plus G plus net export. Note that if there is no factor payments and international transfer, then current account is equal to the net export, NX. In this model, we can treat them as equal, but in general, they are not. This real small open economy with production is extended based on the dynamic RBC model in Chapter 11. It was called all-in-one RBC model. The only difference is to allow for borrowing and lending from the rest of the world at the exogenously determined world interest rate R star, but in the closed economy, this R is endogenously determined by the economy. Now again, let's summarize the assumptions to begin with. We extend the simple two periods dynamic model developed in Chapter 11. There are four economic agents. The first one is the consumer, who maximizes its utility by borrowing and lending to the foreigners. The second is the firm, which maximizes its profit by its investment. The third is the government, which tries to make its ends meet. And the fourth is the rest of the world, which is big enough to the domestic economy to treat the interest rate as exogenous. Note that the second assumption on the firm is a little bit different from the previous simple small open economy model, because now we assume an endogenous investment. Recall that we have a three-step approach to analyze any effect of exogenous variable on the endogenous variable. The first step is to distinguish between exogenous variables and endogenous variables. The second step is to distinguish between the shifts of the curve and shifts along the curve. The third step is to start with a particular exogenous variable and then analyze the effects on the endogenous variables based on the intratemporal conditions, intertemporal conditions, and market clearing conditions. But sometimes it can be complicated because there will be first-round effects and second-round effects. This distinction is also easy. The first round effect is determined where the exogenous variable enters the whole economic system, and the second round effect usually takes effect through the input market indirectly. To show the difference between the small open economy model and the closed economy model, we use the graph on the right to illustrate. In a closed economy, the equilibrium interest rate is endogenously determined by the aggregate supply and aggregate demand at the level of RC. In contrast, in a small open economy, the interest rate is determined by the rest of the world. If there is a net export or positive current account, then the aggregate demand curve will be higher than the domestic aggregate demand. The gap between the two aggregate demands will be the current account. This is how we derive the general equilibrium in the output market in a small open economy, in contrast with the closed economy. The first analysis would be the effect of a change in interest rate, which is now an exogenous variable determined by the rest of the world. This is very similar to the previous slides when the economy opens up and when the domestic interest rate is lower than the world interest rate. According to the previous slide, the current account will increase. And according to the intertemporal conditions of the firm, when interest rate goes up, the demand for investment will drop. We have done that a lot in the previous lectures. So when R goes down on the left-hand side, the marginal productive capital on the right-hand side has to decrease as well. To make that happen, according to the diminishing law of capital, K, or investment, will have to drop. But the effect on consumption is ambiguous, because when interest rate goes up, consumption will go down, according to the intertemporal condition of the consumer. But at the same time, the income effect is positive because Y will increase due to an increase in current account. But overall, the aggregate demand for output is equal to C plus I plus G plus net export or current account. The positive effect on current account will dominate the other two. And as you can see from the graph, the output will increase. Note that the change of the exogenous variable is a vertical axis variable R. According to our experience in previous chapters, this should not shift the curves. Actually, it didn't shift the domestic demand part. The small open economy assumption simply adds on an extra term to the aggregate demand curve. So it is not a shift, but an addition of the aggregate demand curve. So it is not at odds with our previous three-step approach. The second analysis is the effect of government expenditure G. G enters the economic system via the aggregate demand of output. So the first round or immediate effect is on the aggregate demand curve, which is a shift to the right. But in this analysis, we only allows one exogenous variable to change, that is an increase in G. So other exogenous variables like the interest rate R star has to be fixed at the original level. If the interest rate is fixed, then the investment will not change. But when G increases, the taxation has to increase to finance this extra expenditure. That means the disposable income Y minus T will drop, so consumption will drop as a result. These effects on the output market will be transmitted into the input market as a second round effect, because when C decreases, as we have mentioned, it will tip the balance of the intratemporal condition of the consumer. To keep the equality on the right-hand side, when C decreases, leisure L will have to decrease proportionately to cancel out the effects on C. So when leisure decreases as well, the labor supply has to increase. This will shift the aggregate supply curve to the right. This shift can also make sure the interest rate will go back to the original world interest rate level. To summarize, when G rises, the aggregate supply and aggregate demand of output will both increase, leaving the interest rate unchanged. Now let's turn to the third analysis, the effect of productivity shock, Z. Remember that if you are going to analyze this kind of questions in your exam, I suggest you to write out all the intratemporal conditions, intertemporal conditions, and market clearing conditions on a piece of paper before you actually start the analysis. And you should know well which are exogenous variables and which are endogenous variables, so that you know which is the cause, which is the effect. For example, in this analysis of the effect of productivity shock Z is the only exogenous variable we change, but all the other exogenous variables like G and R star, they are all kept unchanged because we can only change one exogenous variable at a time. When Z increases, the immediate effect is through the supply side of the output market. This can be seen from the market clearing condition of the output market. The first round effect is on the supply side of the output market because it is driven on the supply side by Z. When the output increases, the current account will increase, as we mentioned in the previous lecture. Because current account is basically your national savings. When you have more income today, you will save more to smooth your consumption. And again, if the interest rate doesn't change, which is exogenously fixed by the world market, then investment will be fixed. And when the disposable income increases, then your consumption will increase. So the second round effect happens on the demand side of the output market through an increase in C. This results in the right shift of the aggregate demand curve. It also clears the output market such that the interest rate will go back to the world interest rate level. But in practice, because the productivity Z tends to be synchronized across countries, so R star usually drops at the same time, so the investment will increase at the same time, resulting in a higher world interest rate. Finally, let's analyze the effects of the future productivity shock, Z prime. Obviously, Z prime enters the whole system through the intertemporal condition of the firm because the marginal product of capital depends on Z prime. When Z prime increases, the right-hand side increases. But R plus D on the left-hand side are exogenous, they cannot change. To cancel out this effect of a rise in Z prime, you will have to decrease the marginal product of capital on the right-hand side. To do so, according to the diminishing law, you will have to increase the investment in capital such that the marginal product of capital decreases. So to summarize, when Z prime increases, the investment will increase. Similarly, for the consumption, when Z prime increases, the disposable income will increase. This is done by consumption smoothing with the help of credit market. Up to now, it seems there must be an increase in the aggregate demand because C and I are the two most important components of aggregate demand. However, you may forget another very important component, that is the current account. Note that the increase in consumption has to be financed by your future income, and this is done through the credits or borrowing from the rest of the world. So CA, or national savings, will decrease in this case to finance the extra aggregate demand. This is the dominant force on the demand side of the output market. It will shift the aggregate demand curve to the left rather than to the right. And the supply curve doesn't change because it is not the change in Z but the change in Z prime. It will only happen in the future. Unless you are super clever, you may be confused by now where to start the analysis and which are exogenous, which are endogenous, and which are first round, which are second round. To be honest, this is not your fault because graphical analysis is confusing. My suggestion to you is that you have to be very clear of which are exogenous variable and which are endogenous variable. This is the first step of our three-step approach. Without understanding which are exogenous, which are endogenous, you won't know where to start the analysis in step 3. But the complication here is that some variables like wage can be endogenous to the market but exogenous to the individual in different contexts. While in the third step, when you actually do the analysis, you should know where to start the analysis. After a change in the exogenous variable of the analysis, you always start the first round effect, which happens where the exogenous variable enters the system. For example, G enters from the demand side of the output market, so you start with the demand side of the output market. If it is Z, then you start with the supply side of the output market. The advantage of using graphical derivation is that you don't have to use too much maths, but they are derived from maths. Don't forget that they are the same thing, but different perspectives. But the disadvantage of using graphical analysis is that you may get more confused. In your third year and in your postgraduate studies or even PhD research, you will be required to analyze the whole system mathematically. You will be able to derive the solution of the endogenous variables in terms of the exogenous variables, so that you can directly and quantitatively analyze the effect of an exogenous variable X on an endogenous variable Y. But for the exam of this module, you will have to use graphical ways. This lecture extends the small open economy to include investment and analyzes the effects of different types of exogenous variables on the endogenous variables in the small open economy model. But these real small open economy models assumed away money to focus on trade only. The next part of this lecture will introduce money into the small open economy, so our model becomes more and more realistic and closer to the actual economy.